Opening music fades. Hey everyone, and welcome back to the channel, your go-to source for understanding the complex world of finance. Today, we're diving deep into a fascinating corner of the market, hard-to-borrow stocks and the mechanics of a potential short squeeze. We're going to break down why certain stocks become incredibly expensive to short, and what that could mean for their price action. And we're doing it through a real-world, specific example that has caught our attention. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Today, we're putting the spotlight on CCTG Technology International Holdings Limited, trading under the ticker CCTG. CCTG operates in the industrial sector, specifically within electrical equipment and parts, designing, manufacturing, and selling interconnect products across Europe, Asia, and the Americas. This is a micro-cap company currently sitting with a market capitalization of just $3.04 million. Looking at its recent performance, CCTG saw a modest dip today of -2.11%, extending its 5-day loss to -7.95%. However, zoom out a bit, and CCTG has seen a significant run, up +64.18% over the last 30 days. Volume-wise, today was exceptionally quiet, with only 131,817 shares traded, stuck against its 30-day average volume of over 11 million shares. This translates to Xerox relative volume. Essentially, today was a whisper compared to its recent activity. Short chart, CCTG 30-day price action, then daily volume compared to average. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? When you short a stock, you're borrowing shares from a broker, selling them, and hoping to buy them back later at a low price. Just like renting a car, borrowing shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. The higher the demand to short a stock, and the fewer shares available to lend, the higher the CTB fee skyrockets. When you see fees exceeding 100%, 200%, or even more, it signals that borrowing those shares is becoming incredibly scarce and expensive, forces short sellers to pay a premium to maintain their positions. This scarcity is a critical ingredient for potential volatility. Why this stock is hard to borrow right now. Now let's bring it back to CCTG. This stock appeared on our hard-to-borrow screener for some very compelling reasons. Its current annualized cost to borrow fee stands at a staggering 632.5%. Highlight CTB number that is an extremely high fee, signaling intense demand to short and an incredibly tight supply of shares. While the CTB momentum has actually decreased by -46 percentage points over the last 5 trading days, meaning the fee was even higher recently, 632.5% is still punitive for any short seller. Adding to this scarcity, there are currently only 10,000 shares of CCTG available to borrow. When you compare that tiny number to the estimated float of 3.0 million shares, you understand just how few shares are sloshing around for short sellers to get their hands on. Squeeze mechanics explained. This scarcity and high CTB can set the stage for a short squeeze. Imagine short sellers are paying over 600% just to hold their positions. If something triggers buying pressure, perhaps positive news, or simply sustained buying volume, the stock price starts to rise. As it climbs, short sellers begin to feel the heat. Not only are they losing money on their short positions, but they are also hemorrhaging cash daily due to that sky-high 632.5% CTB fee. To stop the bleeding, they are forced to cover their shorts, which means buying back the shares they initially borrowed. This buying to cover creates a demand surge, pushing the price even higher, which in turn forces more short sellers to cover, creating a powerful, explosive feedback loop. Our internal composite squeeze score for CCTG currently sits at 40.1, indicating some notable potential, but by no means a guaranteed squeeze. It's vital to remember that a high cost to borrow, even one as extreme as 632.5%, does not guarantee a squeeze. It can also mean short sellers have incredibly strong conviction and are willing to pay a fortune to maintain their bearish bets. Dilution risk check. One crucial factor for any potential short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can negate or significantly weaken a short squeeze by providing ample supply for short sellers to cover their positions cheaply, or by simply absorbing buying pressure. For CCTG, our check found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days. Furthermore, there have been no recent reverse splits for CCTG in our look-back window. This is a positive sign for any squeeze narrative, as it means the company isn't immediately flooding the market with new shares that could dampen upside momentum. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For CCTG, given its extreme CTB and low shares available to borrow, several factors are worth monitoring. Keep an eye on the trading volume. While today was quiet at 131,817 shares, a significant return to higher volumes closer to its 30-day average of over 11 million shares, coupled with upward price movement, could signal increasing interest. Also, watch the shares available to borrow. If that 10,000 number shrinks further, it increases the pressure on short sellers. Finally, observe the price action itself, particularly how it reacts if CCTG manages to break through key resistance levels, especially after its recent plus 64.18% run over the last 30 days. CCSC Technology International Holdings Limited CCTG presents a fascinating case study in the hard-to-borrow universe. With its incredibly high 632.5% cost to borrow, extremely low 10,000 shares available, and a low float of 3.0 million shares, it certainly has the raw ingredients for significant volatility. However, as always, high potential comes with high risk. This is not a guarantee of a squeeze, but rather a situation worth understanding for its unique market dynamics. If you found this breakdown insightful, make sure to hit that like button, subscribe for more in-depth analyses, and let us know in the comments what other stocks you want us to put under the microscope. Until next time, happy trading and stay informed. And music swells.